What is the difference between an exchange-traded fund, ETF, and a mutual fund?
Yeah, so I mean, they sort of look the same in many respects, but they're not. I mean, they sort of act the same in many ways. The big difference is, and it's not insubstantial, is a mutual fund gets traded at NAV, net asset value, every day. So what happens is you put your order in to buy a mutual fund before the market closes. The market closes. The fund company reevaluates all of its holdings in the funds, plus whatever the how many shares are outstanding, and it gets its value per share at the end of the day after everything's closed. Now, everyone who put a sell order in gets that price. Everyone who puts a buy order in gets that price. Easy. The issue is that inside of this entity of the mutual fund, and they are entities, right? They're usually set up as trusts. Inside of this entity, there are, as they're buying and selling these shares to redeem or to create more. Well, you have to create more, but as people are redeeming, they have to sell to get the cash, or they have to pay fund expenses for paying the people that work in the fund. They have to sell, and when you sell, you either create capital gains or capital losses, and so they will create capital gains inside of this inside of the mutual fund. Now, one of the new rules of mutual funds is they have to distribute 98% of all income. Then it's dividends, and that's capital gains. So on your 1099 DIV, there's a section on there that says capital gain distributions. And what that means is that is what the fund itself has liquidated to create cash flow for investors. And that ends up on the individual investors' tax returns, whoever holding them, when the capital gains get distributed, which is typically in December of the year prior to, in December of the year end, because that's when they can actually tally up, all of their capital gains and all that. So that gets shipped out. Now, an ETF operates very differently. An ETF doesn't have that. It has a NAV. It has a value of the underlying assets, but it doesn't trade necessarily at NAV because it trades intraday, meaning during the day, as opposed to when the day ends. So you put in a sell order, at noon, it's going to sell at noon, assuming you made it a market order. Because that's the case, there can be premiums and discounts on those shares. So if for some reason the market sours on U.S. small cap and no one wants to buy U.S. small cap, and you're holding a U.S. small cap ETF, all of a sudden, not because the underlying assets have gone down necessarily, but people have just soured on the whole thing. All of a sudden, the share value will drop, and it'll be below what the NAV is. So there's a risk of premium or discount. Well, the risk of premium, there's no. I hope there's premium, right? But but if you buy the shares and then there's a subsequent discount, you can lose value without the underlying shares losing value. The benefit is the way that an ETF works is because it doesn't sort of do that end of the day trading between everyone public. They have they have companies out there called approved participants, and what they do is they can create their very specific people that are approved to do this, or entities that are approved to do this. They can create shares, or they can take away shares. They can go to the public market and dismantle the shares. And so the ETF will go out if, let's say, there's a premium floating out there, meaning the ETF is trading above what its value is. What the providers will do is they'll say, that's great. We're going to create more shares, using all the underlying parts, and then we're going to sell them on the market, and we're going to get more than the underlying value of the shares. So that's how they collect on the premium. Also on the discount, right? If there's a discount, they say, well, gosh, the fund is worth less than the sum of its parts. We're going to go to the market. We're going to buy the discounted shares. We're going to pull them all apart, and we're going to sell the individual components, and we're going to make money that way. But one of the interesting things is that they can actually, instead of selling things in the fund, what they do is they trade pieces out. And so they can avoid some of those capital gain distributions because they don't need to make the sale. And so typically that's what they try to do. They try not to have capital gain distributions. They try to instead substitute different parts in on the portfolio. So again, it's a lot more complicated than a mutual fund. there's more pitfalls with that with the premium discounts, but there is more tax advantage on an ETF. Yeah, and you have and you have to be very careful with that when if it's so there's things called thinly traded ETFs, and thinly traded ETFs means there's not a lot of volume, and there may not be the number of participants, and so that can vary wildly, from the net asset value to the discounts and premiums. That's not necessarily a good thing. So again, the more thinly traded stocks, and again, small stocks again are typically thinly traded, you can run into a big problem. And there was an issue a couple years ago with municipal bonds. The market had sort of gone haywire on it, and there were a couple of ETFs that people were a little scared that they were going to sort of collapse because the market wasn't there. And so when an ETF collapses, basically what the fund does is it takes all the shares that it's sitting on, because all these different ETF shares represent baskets of stock, and they'll take back the ETF and they'll distribute the basket of shares. So people would have ended up with these baskets of shares with, who knows what cost basis. It would have been a mess. So thankfully it didn't happen. But again, the more exotic, the smaller, the emerging markets, those tend to have more issues with premiums and discounts. Vanguard has enough volume that usually it's not a problem. Um, but some of the smaller ones, you got to be careful.